Geoffrey Dennis is with us, independent markets, emerging markets commentator. Geoffrey, great to have you with us here. Thank you for your time. So let's start with China, not India for once. And that old question, is this time different? I'm asking in the context of all the false starts we've had in the last 3 years in China, right? But those false starts have meant 30, 40, 50% rallies, which then eventually got sold off. So nothing to scoff at. But is this time really different with the promise of fiscal push as well, which so far has been absent? Go on.
Yes, I'm not actually very convinced. I think what China really needs is the fiscal push, and we need to see what the details of this fiscal push will be, because as you've already commented in the program, we've seen monetary easing of a whole variety of instruments over several months without having any real impact on the economy. The key in China is the weakness of consumer spending, the low level of consumer confidence, and the inability of the government to be able to switch the sources of growth from investment and exports towards consumer spending. In my humble opinion, to get that going, you've really got to get the property sector back on its feet, and I don't think these measures necessarily do that. And you've got to see the consumer doing well through improved, as I say, confidence and improved spending. And I'm not sure you're going to get that. So I suspect, unfortunately, this may well be another false dawn.
What is the sense from here on, Geoffrey? Good morning. Now, we have the Fed lowering, and the China stimulus is definitely being noticed by the market. There's a lot of buying going back in the Chinese market, though, of course, the economic numbers still are looking weak. What is the sense? Do you think China finally will emerge out of the slump that it's in? So is the market enthusiasm well placed?
I think the market will probably run for a while, because I think this package of measures, certainly on the monetary side, and various financing supports for mortgages and for buybacks and for equity investment, was a big surprise. It was a big package, obviously, earlier in the week, and obviously there's some hope now that fiscal will add to that. And I think that will provide some support for the Chinese market for a while. I mean, China's up, according to MSCI, well into double digits over the last week. It's been a very impressive move, including today. The question is, do you chase it? Do you chase it hard? And I'm not sure you do chase it very much for the reasons I've suggested. Now, obviously, the news looks pretty good all around, because the Fed is now underway with a 50 basis point cut. I thought they'd probably only move 25, but I think what we've got now is a very sensible dot plot from the Fed. The first one that's really been quite believable, and that is we're going to get 2 more cuts over the rest of the year and probably 100 basis points of cuts next year. And given how reasonably solid the US economic data is, GDP revised, or I should say unrevised, but coming in again with another release today at 3%. The economy's okay, the Fed is easing, we're heading towards 2% inflation. So I think the outlook for equities generally globally looks pretty good, but I'm still a little nervous about whether we're actually going to see Chinese growth break out of this 4 to 5% growth range, which is what you need. For that, you need a stronger consumer, and I'm not convinced you're yet going to get that.
Interesting. Hi, Jeff. Morning. Good to see you in. You're not sounding too optimistic about the Chinese market out there, even going by the stimulus that they've announced. You want to wait and watch. What does this mean for India, though? After a while, the Chinese markets have outperformed the Indian markets just in the month of September. If you look at it in the last 4 years, they have been big underperformers. In the near term, though, do you think, give and take everything, 6 months to around a year, will the Chinese market outperform the Indian markets, given the valuations, given the flows that we have seen, outflows from China?
I actually doubt it. I think India will probably outperform. I put a piece out about 36 hours ago, prior to the fiscal announcement, to be fair, where I said, is this time for the big rotation? And I don't think it is, the big rotation from India to China. And I don't think it is, for the reasons I've suggested. My skepticism as to whether this is really going to stimulate the Chinese economy significantly. I still think the fundamentals in India are better. in terms of economic growth, for sure. Now, of course, we've always got challenges with valuations, and no doubt India's done very well over a sustained period of time, whereas China's done horribly. And the net of that, of course, is that China's weight's gone from 43% of the MSCI EM in late 2020 to 24% at the end of August. India's gone up from 8 to nearly 20. I think that's going to go a little bit further. If I were putting money on the table on a 1 to 2 year view, I would still, at the margin, prefer India because the fundamentals are better despite the valuations. I just want to see a bit more evidence in China that you really are going to see the consumer moving, because without the consumer moving, this is all going to do very little for the Chinese economy, and we're going to be stuck somewhere around 4 to 4.5% growth.
No, absolutely. Geoffrey, by the way, did you watch David Tepper last night on CNBC? And we'll play out sound bites in a bit.
No, I actually didn't, but I do know what he said, which is basically, load up on China, I think, after the Fed cut. And so that was a nice call. But and obviously it's had a but
no, but as you say, we'll find out if it's a nice call or not, but it was an emphatic call. Thank you very much, Geoffrey, for joining us. Great speaking with you. And as I said, we'll play out those sound bites in a bit from now. I don't know.